This is Barry Zalma speaking for Zalma on Insurance on YouTube. Today we're going to talk about the history of insurance. The essence of insurance is the spreading of risk from one person to many. As early as 1200 BC, Phoenician merchants began transferring some of their risk to the backers of specific voyages, whereby the backers would profit if the voyage was successful, but would lose their investment if the cargo was lost at sea, either from natural disasters or from pirates. In exchange for backing a voyage and to assure payment if the voyage was successful, Phoenician law allowed the lenders to confiscate the merchant ship for non-payment. This form of collateralization loan was called bottomry. This term probably arose because the ship's hull was referred to as the bottom. Since substantial resources were required for voyages and the wealth of these early nations depended heavily on trade, other settlements around the Mediterranean and in Asia also enacted bottomry laws by 400 BC. In 300 BC, the Babylonians developed a system of loans for shipments by sea. Merchants found the risks of shipping by sea to be too great to take on a loan, since the loss of one ship could bankrupt a merchant. With insurance, the risk of shipping was equitably spread among those subscribing to the loan. Another means of lowering risk was to transfer at least some of the risk to moneylenders. The Great Code of Hammurabi allowed the transfer of risk from merchants to moneylenders so that if their merchandise was lost or abandoned, then their loans to the moneylenders were forgiven. The Phoenicians and Greeks permitted ship owners and merchants to pledge either the ship or the cargo as collateral for loans, so that they could either obtain the loan or get a lower interest rate. Some lenders decided to assume a greater risk in exchange for charging a higher interest rate by forgiving the loan if the ship or cargo was lost. These early versions of marine insurance were more like a modern football pool than insurance as we know it today. A stakeholder would simply hold the bets of the merchants, the premium, until the ship returned to port. If it did not return, the stake would be paid out to the merchant whose cargo was lost. If it did return, the stake was paid out to the other merchants, who earned a healthy profit on their gamble. Since the merchants were betting on each other's success, the loss of one ship could be absorbed by the entire merchant community. By spreading the risk, the merchants made trade by sea economically viable. One of the earliest marine policies to have survived was issued in 1347, concerning a shipment from Genoa to Majorca on a vessel called the Santa Clara. The policy was written in a form that characterized the premium as a loan to the insurer from the insured. The loan was repayable only if the cargo failed to arrive. If the cargo was lost, the loan was repaid to the insured for twice the amount of the loss. In many situations, the premium or interest rate reached 100%. That may seem steep, but it reflected the excessive risks faced by merchants of that time. The custom of insuring maritime ventures was well established in England by the end of the 16th century, as indicated by the 1601 Act of Parliament entitled An Act Concerning Matters of Assurances Among Merchants. This is the first known statutory recognition of insurance. It was an attempt to regulate what at the time was a new business. Since then, many thousands of laws have been enacted around the world to regulate the business of insurance. For example, the creation of Lloyd's of London in the 17th century, where Edward Lloyd placed a notice board with a maritime information in his coffee shop near the Port of London. Because he made maritime intelligence available, marine merchants gathered in his shop. These merchants eventually made agreements to share the risk of loss in shipping. The agreements were simple contracts. For a charge, the insurers would agree to pay for losses due to the perils of the sea, in proportion to percentages chosen at the time the insurance was written. If there was no claim, the insurers would share in the profits of the venture in the same proportion. The insurance contract was then signed by the people willing to take the risk, with each specifying the percentage of the risk he was taking. Since the names of the insurers were always placed under the contract term, the insurers became known as underwriters. The assembly of insurers under a single roof established Lloyd's of London as the first modern insurance market. Lloyd's method of transferring insurance became the cornerstone on which the modern insurance industry was built. Lloyd's survives today as an insurance marketplace, the building at 1 Lime Street, London. In the United Kingdom, where insurance is transacted by Lloyd's underwriters, it is operated by the Corporation of Lloyd's. The Corporation of Lloyd's, however, is not an insurer. It owns the building where the underwriters transact the business of insurance. The insurers who sign on to a particular risk, usually syndicates of multiple individual and corporate insurers, are properly known as the underwriters at Lloyd's, London. When Edward Lloyd died in 1712, his son-in-law William Newton succeeded him, and the coffee shop subsequently passed through many hands. Although marine underwriters gathered there in the early 1700s, it is not clear when it became a true insurance marketplace. The best evidence suggests that Lloyd's developed gradually as it provided increasingly comprehensive insurance and world shipping news to those involved in the maritime and insurance businesses. Lloyd's became more cohesive and professional over time. In 1800, its underwriting room was restricted to merchants, underwriters, insurance brokers, and bankers, all of whom needed to be recommended by 2 or more members. A £15 subscription fee, a large amount of money in those days when most people might earn a total of £40 a year, helped control chaotic overcrowding and eliminate undesirables. Lloyd's prospered with the British economy. During the Napoleonic Wars, insurance rates generated large profits. Prices of goods also moved upward, benefiting underwriters. In 1811, Lloyd's was London's only marine insurance market. However, with the 1812 Battle of Waterloo, Lloyd's first golden age began a steep decline. By the 1860s, Lloyd's was still a small institution providing facilities for marine insurance transactions. It would take another decade before the foundation was laid for building a much stronger organization. The Lloyd's Act of 1871 created its first detailed constitution, sanctioned by Parliament, and established the Lloyd's Society as a legal entity. The Lloyd's Act defined the Committee of Lloyd's authority and duties, delineated rules for underwriting members, addressed punishment of members, and gave the committee the right to grant underwriting room admission to persons called associates not engaged in the insurance business. The modern market at Lloyd's is much different. In the modern market is a place where groups of individuals and corporations can transact insurance of any kind. After hundreds of years, it has developed a strict method of placing insurance. It has been described as follows. The corporation at Lloyd's never sells insurance in itself and is not at risk on the insurance sold on the floor at Lloyd's. Rather, the underwriting members subscribe to cover all or part of a proposed placement of insurance at their own election. Numbers of individual underwriters, many in England, but others scattered throughout the world, have joined together to form syndicates. Syndicates may have anywhere from 2 to 3 to hundreds of members. The individual members are known as names on that syndicate. These syndicates are the entities which subscribe on behalf of their members to cover risks and percentage parts of risks. The actual potential liability of a given name depends upon his percentage share of the syndicate of which he is a member, as well as the percentage of the risk to which his syndicate has subscribed. Lloyd's is now the market of last resort. Unlike other insurers, Lloyd's offers sufficient affordable insurance against almost any risk. The Lloyd's system is so successful that it has been imitated worldwide. Lloyd's also reinsures, that is, insures the insurance issued by other insurers. Almost every insurer in the insurance business. Lloyd's describes its market as follows, quote, "Unlike many other insurance brands, Lloyd's is not a company, it's a market where our members join together as syndicates to insure risks. Much of Lloyd's business works by subscription, where more than one syndicate takes a share of the same risk. Business is conducted face-to-face between brokers and underwriters in the underwriting room. When we talk of Lloyd's, we're really referring to two distinct parts: the market, which is made up of many independent businesses, and the corporation of Lloyd's, which is there, broadly speaking, to oversee the market. These parts are distinct but far from independent. Both work closely to maintain high standards of performance across the market. When insureds receive Lloyd's policies of insurance, what they actually obtain are commitments from each individual, corporate, limited liability, or partnership insurer, the underwriters, to pay claims up to their entire assets. The names are jointly and severally obligated to the insured for the percentage of the risk each has agreed to assume. The insured, if there is a dispute over a claim, need not sue each name individually because the typical Lloyd's policy contains a clause providing that any name can appear as representative of all the names, and each name is contractually bound on an individual basis to the insured to adhere to any adverse judgment reached in a suit, notwithstanding that only one name participates in the litigation as a named party. The names pledge their entire fortune, every pound and pence of their assets, to pay claims. Some names have lost everything paying claims, while most have earned substantial profits. In the late 1990s, Lloyd's changed its rules and allowed corporations with the limited liability provided by the corporate form to become insuring names. Now the investors at Lloyd's who are in the corporate form only risk the assets of the corporation rather than their entire personal fortune. Insurers in the U.S. do not have the tradition of unlimited liability and professional insurance practitioners that exist in London at Lloyd's. Nonetheless, case law from the UK furnishes some useful precedents for the American industry and for Americans insured at Lloyd's.